Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
All right, there's a new intro, so I got to get to the core of it. We're doing the short form one. You said do a longer one. Dude? I already botched it. All right. Karl, man, thanks for coming on the show. For those who don't know who you are, haven't heard of you, we'd love to get your background as a real estate investor and everything else that you've been doing.
Cool. Hey, guys, thanks for having me. So my background started in law enforcement. I was a cop in Philly. All that kind of led into real estate investing first. I started seeing all the construction going on around me when I was working, and I networked with a few investors that were flipping houses, buying rental properties in my areas, and that kind of sparked the real estate bug. I actually had a duplex that I was house hacking. I didn't even know what house hacking was at the time. When I went to buy my first house, my dad gave me the idea, and he said, "Hey, why don't you buy a duplex? You're single, you don't really need a big house. You can rent one unit out." And I was like, "Yeah, that's a great idea." So I bought a duplex when I was a cop still. Like I said, I didn't really know I didn't really think of it as like a real estate investing. I was just saving money every month. That kind of then sparked, the bug of, hey, I'm getting paid rent. This is pretty cool. I'm going to look into this further. Found bigger pockets. Meanwhile, I'm driving around the district, networking with other investors, seeing how they're flipping houses and stuff. And everything kind of just spiraled into, really learning real estate investing. And my dad was retired from construction, so it kind of worked out well where him and I partnered on some flips, partnered on our first rental property together. And that kind of took off. I was doing both for a while. I was still working as a cop. I was doing, a flip at a time, nothing too crazy, picked up a handful of rentals. That kind of, led into partnering on some seller finance deals with some other people for some more, rental properties. I was a GP in a portfolio of properties. And then eventually that kind of led into, what I'm most passionate about now, which is infinite banking. And, every real estate investor, I wouldn't necessarily say it's a problem, but every real estate investor is always looking for more capital. More capital you have, more deals you can do. That kind of led to where I was, looking for more capital to do more deals. I found my firm and was there, as a client before I actually worked there. And as I was a client there, the owner of the firm kind of took me under his wing and was really coaching me how to use these policies to acquire more assets. So I was using my first policy to, just typical Burr houses. I was using the cash value of my policy to fund my down payment and any kind of, cash out of pocket I needed. I was using a combination of cash value and private money at the time because I didn't have when I first started, I didn't have the cash value to fully fund, an entire flip or a Burr. So I was just combining it. That kind of, grew from there. My passion, once I kind of learned how it worked and physically did it myself, is where it kind of all, took off of becoming really passionate about it. And then in the meantime of all of this, I got my realtor license too. So
nice. Okay, perfect. Man, you just threw out a ton of stuff there that people are probably listening and going, what the hell does that even mean? What is that? So I want to go back to your investing where you started as well here in just a minute. But first, the whole infinite banking concept you just talked about. Give us like the explain like I'm 5 version of that.
Okay. Explain like I'm 5. So if Michael Scott ever asked me what infinite banking is,
there we go. Yeah.
Yes.
The idea is there's only one pool of money in the whole world. The founder of infinite banking, Nelson, he would explain it, from like a real high level overview. Think of the pool of money in the world as the globe. So the globe is just one giant pool of water. And, obviously we have continents and we have land, but all of the water is interconnected and it's always flowing. It's in constant motion. So, every ocean is connected to rivers and seas. It's all always in constant motion and it's always flowing. and the water always flows back to this one giant pool of water. Well, our monetary system and the central banks have created a similar system where there's only one pool of money, and it's always moving, it's in constant motion, and it always flows back to them. So, to put this into kind of perspective, if you go out and you buy a coffee, money's going to go from your checking account to whatever Dunkin' Donuts business bank account. So it flows from bank to bank, but it flows back to the central bank. They're going to pay their employees. It's going to go from business bank account to the employee's personal checking account. They're going to go buy groceries, bank to bank. It's always flowing back to the central banks. So what the infinite banking concept is a strategy where you can essentially take a portion of that pool of money. You can't create your own pool of money, but you can take a portion of that pool of money and use that as your pool of money. So it's, when you're spending money, making purchases you're going to make anyway, primarily large purchases, it's keeping the money flowing, but flowing back to you and your quote unquote private bank. That's what it is. The way it works is, we utilize whole life insurance policies specifically designed for this purpose. It loses a lot of people when you say life insurance. Life insurance is not a sexy product at all. A lot of people do not even understand life insurance. In death, everyone just thinks life insurance is, hey, when you die, your family gets a death benefit, which is true. That's the death benefit of a life insurance contract. There's also living benefits of a life insurance contract as well. And we can tailor, when we design policies, you can tailor the policy to focus on living benefits versus the death benefit. So it's a sense of basically creating a pool of money that you can use, you can transact. It's going to continue to grow even while you're using and transacting it and transacting with it. And you can recapture a lot of, opportunity cost or interest that you would have gave to a lender.
Yeah. Okay. I got a bunch of questions, but I want to ask the first one. You said a whole life policy, yes, basically designed specifically for infinite banking. What is the difference in this designed policy than the one that my financial advisor pitched me 10 years ago?
Sure. So let's start at the top. So life insurance, if it's a big umbrella, there's term insurance and there's permanent life. Term is for, a term, 10, 15, 20 years terms. If you die within that term, your family gets a payout, a death benefit. Permanent life insurance is good for your whole life. It's permanent. Underneath that permanent life insurance umbrella now, there's different products under that category. So there's whole life insurance, there's index universal life, there's variable universal life, equity universal life, all different products. Whole life has been around the longest. Whole life insurance has been around before the tax code. Within that product, we would never use the other products for a couple reasons, mainly because they're invested in the stock market. They experience volatility. They can go down. Whole life cannot go down. It's paid a guaranteed, minimum interest plus you get dividend. So whole life insurance now as that product under the permanent life insurance umbrella, under the life insurance umbrella. Whole life insurance can be designed through different riders, different splits, different carriers. They all offer a different product. A mass whole life product could be different than, a Penn Mutual whole life product. Even though they're both whole life, they're two different products from two different carriers. So when, someone comes to us, as a client and they say, hey, here's my situation, here's what my goal is, here's what I want to do. We tailor the product to meet that situation. There's no one size fits all, really. And now when it comes to designing the whole life product, a lot of people think whole life, and like Dave Ramsey has talked negatively about whole life. Mm-hmm. That's a conventional whole life product focused on death benefit. An infinite banking policy is focused on living benefits. So what I mean by that, there's certain riders, like I said, you can add to a policy. When you add that to the policy, you can increase the amount of your premium that's going to your cash account versus what's buying more death benefit. So think of it kind of like a scale. You can have, if you're paying, $1,000 a month, it could just be going into buying you $1,000 worth of death benefit. you can fluctuate that scale to where, hey, you know, maybe we're going to put of that $1,000, 300 is going to buy us death benefit, and the other 700 we can stash away in this cash account that's going to grow, you know, guaranteed, uninterrupted interest. We can leverage it to go acquire more assets. You can fluctuate that. So you could go, you know, say a 50-50 split. You could go 60-40. 30-70 is kind of where, you know, most people would fall around. It's going to depend on risk class. So basically your age and your health. That we'll see how low we can kind of get that. We don't want to go too low because it could trigger, you know, they call it like a MEC, which is it's a taxable event. So we don't want these policies to ever become taxable. We would not design them to become taxable. So we have to, you know, get right on the line of where it's safe from taxes. But that's, you know, essentially how you design it. And that's where, so in the infinite banking world, there's the Nelson Nash Institute. Nelson Nash, he's, you know, like I said, the founder, father, whatever you want to call him, of infinite banking. He created a institute training life insurance agents how to design policies in the infinite banking way. You know, every life insurance agent in the world will, you know, tell you they know how to design these policies because it's, you know, a high commission ticket. That being said, you know, there's certain things and certain ways to design a policy specifically for infinite banking. Certain carriers you use, certain types of carriers. You know, we always want to look at how long the carrier has been in business. All kinds of things. We never use, not that we would never use, but ideally you want to stick to a mutual insurer, not a stock insurer. You know, several different things. So that's why I always kind of, you know, we get clients all the time that come to us and say, hey, you know, I had my brother-in-law, you know, design me a policy like this. Can you take a look at it? And then it's, you know, some kind of VUL with a stock insurance company. I'm like, dude, this is not a infinite banking policy at all. You know, and whoever designed this policy is not an authorized IBC agent with the Nelson Nash Institute. Because you can't do that. If somebody comes to you with that, it's, you know, we have our board of ethics through the state, you know, like the state insurance departments, but then we have a separate board of ethics through the Nelson Nash Institute that we have to abide by, which is, there's certain things we can't design because of that.
Gotcha. Okay.
So I'm going to break it down even a little bit simpler because I have a policy. Basically what you can do is you can pay your premium, which tends to be relatively high. That'll give you access to a certain amount of life insurance, but a portion of that premium, or potentially all that premium, I guess your premium that you put in, it receives the cash value of it receives a pref sort of payment that you get every single year. Like mine's like 5% or whatever it was this year. Yep. But then you can also leverage that and you can take a loan on that equal to the amount that you typically get paid. So you can use that to go and perform business, do whatever you need to do. So like for mine right now, I think I have like 50 grand in there. I can go and, you know, it's getting 5% per year. It's like surplus cash, but I can also get a loan for, I think it's up to 90% of it or something that I can pull out at 5% that I can then use to go and flip a house. I can use to make other investments. So basically, while I'm pulling that money out, I'm using it to make more money. My cash value principal that's in there is still collecting interest every single month at like a higher than normal rate from like a bank account.
Yeah, that's, you know, exactly it. Perfectly how you use it. You know, the biggest thing is when you compare this to other accounts, if you were to, you know, if you had 50 grand in a separate account, if you were to go borrow from it, it would actually come out of the account. With the life insurance, it's actually not coming out of your cash value account. Your cash value account is, you know, think of it as the insurance company putting a lien for that portion on your cash value, but the funds actually come from the general account of the insurance carrier. There's also too, Mike, you can borrow, you know, up to 90% of your cash value through the insurance carrier. There's also certain institutions that will allow you to create lines of credit across multiple policies, and they'll actually go more than 90%. So one of our, you know, relationships we have with an institution, you can combine as many policies as you want, as long as you're the owner of it or your family, you know, if it's like husband and wife, and you can get one line of credit across multiple different policies up to 100% of the cash value.
Wow. Yeah. So how much is there a limit to how much you can fund one of these? So Mike said he has 50. If I go call you tomorrow and I want to put 200,000 in cash in a policy, can I do that?
You can. There is a limit. It's $500,000 a year. Now it may not make sense to do that in one lump sum. We would have to have like a strategy call, see, what the goal is, but sometimes you may want to break that up over like a 5 or 7 year period. You may get better growth that way. So when you do start a policy, you can front load it with a lump sum like that. When you do that, it inflates your base premium, which isn't necessarily a bad thing. It depends on, the situation. Some people don't like that inflated base because your base is required every single year.
Gotcha.
Within your premium, you have a base premium and then you have a paid up addition rider. Your paid up addition rider is not required. Your base is. You have to pay your base every year or else your policy could lapse. Now, by front loading the policy, it'll increase that base. So, just for easy terms, say you had like a 30-70 split, 30% base, 70% PUA, and you wanted to front load it. That may inflate that to 35-40% base, 60 or 65% PUA, which isn't, like I said, it's not a bad thing. It works out well. Like I have a client now that he wants to buy a Dodge Viper before his 40th birthday. So we're working to get him enough cash value into his policy before his 40th birthday. So we're going to front load it like that, which again, it's going to increase his base, but then he'll have the cash available to borrow from it to go buy this car. If he was not front loading it, then we wouldn't be able to do that. There's not enough time to get the cash into the policy.
So he's going to, what's the advantage? That's a great example. What's it for a car for I guess it could be considered an asset, but what's the advantage of him putting money in that policy and then loaning himself the money for that car? Where's the advantage?
Sure. So he's going to spend the money anyway, whether he does it in cash or he finances it from a bank. He's already got it set in his mind. This is what he wants. So he's going to spend it regardless. When you fund it or finance it through your IBC policies, it's the most efficient way to do it. When you spend cash, you're losing opportunity costs. If it's a $80,000 car and you're spending 80 grand cash, that money is no longer working for you for the rest of your life. So when you spend cash, you lose opportunity costs. If you finance it with a bank, obviously you're going to pay interest to a lender. That's the second way you spend money. Third way is if you were to borrow from your own policy, pay back the funds to your policy, you're not going to lose opportunity cost on the money because it's going to continue to grow while you borrow from it to go make the purchase, whether it's a car or anything. It could be an asset or a liability. It's going to continue to grow. So you're not losing opportunity costs, and the interest that you're going to pay back to the policy will come into your account as interest and dividend. So you're not necessarily making more interest. I mean, you could charge yourself more interest if you wanted to,
right.
But you don't have to. It's just, there's good videos and good illustrations to show the three scenarios: cash, financing, self-financing. And over the long haul, you're never losing opportunity costs. You're not spending any money to a third party finance, a bank or anything. And the more time that you give your policy, obviously the more it's going to grow, to where it's, everyone likes to pitch, and I'm sure you see it on like social media. Everyone's like, oh, I make money by buying cars this way. You don't necessarily make money. You would have made it anyway, no matter what you bought.
Right. Yeah.
It's just,
okay. So I think I get what you're saying. So then you're saying you're going to buy this $80,000 Dodge Viper. Your money is, sitting there making 5% regardless, say if that's your quoted interest rate. And then you're going to have to pay yourself essentially interest on the money you borrow. And so say you were going to pay a bank $90,000 total, including interest for the car after you pay the loan down. Well, instead pay yourself the $90,000. So you take the 10 grand that would have gone to the bank and you just give it back to yourself. You're not earning the 10 grand. You're just paying it to yourself anyways.
Correct. But you're also getting the lifetime growth of the funds in the policy. So you have two opposing forces. You have compound interest working for you, and you have amortizing interest working for you, but in the opposite way. So compound interest is going to go up. Your amortized interest is going to go down, similar to, like a mortgage payment.
Right.
Exactly. Yeah.
Cool.
So for any sort of person that has a business, this is why it's so keen with real estate investors too, that have large cash positions. It's kind of just a no-brainer, right? Because you can, hold your cash reserves for like your entire rental property portfolio in there. Let's say, we have 40 something units between Dan and myself. So, typically have a couple $100,000 in cash on hand just to be safe, right? But to put all that into something like this, where it's going to be getting compound returns at 5%, but then we can borrow from it at 5%. it allows us to not be sitting on those $100,000 just in straight cash when we don't need it. And then sure, when we do have to pull on it to replace a roof, replace a furnace, do whatever, we're going to have to pay that back with a little bit of interest, but that's going to us. That's going back to us, right? And, ideally, it's going to be paid down by the cash flow of the assets that you've owned anyway, so it shouldn't really matter that much. But like you do that over the course of your entire investing career, we say we didn't buy any more units, you only have these 48 units, that we're going to always have this cash sitting anyway. You're going to get compound interest at whatever our guaranteed rate is over the course of the investment cycle. So
I like that. I would say probably, I'd have to actually look into it, but it's probably close to like 70 or 80% of our clients are real estate investors. And they use just like same exact, how you said it, they just keep this as their reserve fund. Or what's a pretty cool strategy too, is you can actually, if the bank allows you to not escrow your insurance and taxes with them, there's cases where, some big real estate portfolios, the annual property taxes could be, $30,000 a year. And rather than having that sit in a bank's escrow account doing nothing for you, sit it in your policy and just make the payment every year. It's money you're spending anyway, just a matter of where you're storing it in the meantime.
Yeah. I mean, that is actually a good point with the escrow, because like, I don't know if a lot of people realize this, but if you have, if you live in a state where your bank escrows your taxes and insurance, that's technically an asset that's still yours, that's just sitting there doing nothing. And if you own a bunch of properties, like that can literally be hundreds of thousands of dollars.
It'd be a lot of money.
That are being wasted. So
yeah, there's a speech on, so as a Nelson Nash Institute practitioner, we get access to a bunch of different training videos, and they have a video in there with a guy who designed a policy for another investor. He wasn't my client, but his annual property taxes were $200,000 a year. And I mean, you can just only imagine the compounded growth of $200,000 a year, even when he's borrowing it to then pay his taxes bill, the compounded growth exceeds that, by tenfold because of the amount of, I mean, it's a ton of cash you're putting in there.
I mean, let's say at 5%, that's $10,000 a year in extra money that you're making.
Yeah. So basically you would be escrowing it at a bank anyways. So just escrow it to yourself in this policy and then spend it at the beginning of the year and then pay it back till the end of the year and then spend it again. And you're compounding. Yeah, that's amazing.
The other cool part too, is, we have a lot of people that they just use it, as a private kind of retirement income. So you can draw income from the policies, so if you have your other retirement accounts set up, which, I don't necessarily believe in all of them, but regardless, if the market's down and you don't want to draw from your, perfect timing this year, market's down, 30% or so, it's probably not a good time to draw from a retirement account. If you had this other, plan B in place, you could draw from this and let the other account sit, while you don't want to draw that while it's down. But the cool part too is all these policies, you have a cash account, which is, the primary reason we're doing it. You get a death benefit too, which is just a cherry on top. So your death benefit's a multiple of the cash account. So, say you got 200,000 in your cash account, the death benefit could be $5, $6, $7 million. So God forbid you ever do pass away, your family's not getting the 200,000, they're getting the 5, 6 million. So, we're really looking long-term, and what we like to do with our clients is really get, their small, not small, but their short-term goals, 5, 10, 15 years, but we're planning, we do a lot of legacy planning too, and planning over multiple generations. So if clients have kids or grandkids, we like to structure policies on the kids and the grandkids as well. And then we'll establish a trust where the death benefit goes to the trust. Inside the trust, we have, a family banking addendum that says any child born into, the Schnitzer family will have a whole life cash value insurance policy designed the IBC way, blah, 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 whatever. And the trust will fund their first premiums. So now that policy that's on the child that's born is going to grow and compound from the 15 days after they're born all the way up until the day that they're die. So they're going to have, 70, 80, 90 years of compound interest working for them. Death benefits growing, which is going to go back into the trust and fund the next generation too. So when you really scale this out over, 200, 300, 400 years, I mean, people call it the Rockefeller method because it's what they've done. They have compound interest working for them, which we all know how powerful it is, for 300, 400, 500 years. Go put that into it's probably not 500. I think the max right now is like 250, maybe 300 years. Whole life has been around longer than, any other institution, but put into a calculator 200 years worth of compound interest with massive lump sums coming. At each death, there's a lump sum that gets put in. So you can really scale this out, and the idea behind it is you're just creating, again, that pool of money that you can bank with, and obviously the bigger pool of money, the higher interest you're going to accumulate. So,
yeah. So it's basically, it turns into like a giant savings account that gets premium interest, but you can also borrow from it. And, as opposed to having to get a loan from a bank. So, yeah, I mean, it's a no-brainer. So with this sort of product, these sort of deals, what sort of financial status do people need to be in? Is this something, because I think one of the reasons that, Dave Ramsey hates on it, I mean, obviously, like you said, those are blanketed programs that he talks about, but there's also always the stories of like, these are the kind of plans that get sold to like, families who immigrated here who don't necessarily speak good English or understand American finance, and they have super expensive premiums that most people should not be paying. So I guess for this style where you're having the custom plans, is this something that only people with significant net worth should pursue? Is this like right for like a new investor? Like, who is this correct for?
It works for everybody. It does work for everybody. Now, how quickly it will work for everybody is, the obviously it's going to work quicker for somebody putting, 25, 50,000 a year in than it is for somebody putting $3 or $4 grand a year in. You're not going to have enough cash value to finance a car for 10 years if you're not putting enough premium in. So, that being said, the perfect client or the perfect, fit is somebody that is already saving money. So, we always recommend minimum 10%. If you're not saving 10%, focus on that, and then come to us, whether that's, in a few months, in a year, in 2 years, you got to be saving at least 10%. Now, where we keep that 10%, we would recommend here. So even if it is a smaller amount, only a couple $1,000s a year, it still is the best place to park it. Are you going to be able to finance a car or a rental property with it in the next 5 years? No, there's not enough cash going into it. You have to be able to inject cash into it. So what we would say is, look, let's set this up, and then we'll focus on, how do you, as your, what are your talents? What's your passions? How do you create, more income for yourself? So we have, if you go on our website, which is producerswealth.com, you'll see a big diagram of, we call it, the cash flow multiplier the capital multiplier. And essentially all that is a, no matter what business or what industry you're in, we're all in the industry of creating capital and multiplying capital. So whatever business you're in, your goal is to multiply capital. You're not doing it if you're not making money. So within that, you'll see on our website, we have 4 different pillars. The first is capital creation. This is, however you earn money, whether it's, real estate commissions, insurance commissions, rental income, flip income, doesn't matter what it is, a salary, W-2 income. How you have, you have capital creation, how you earn income. Then you have to store that income somewhere. So we call that capital capture. Where you store that capital, there is a most efficient way to store it. We wouldn't necessarily recommend a bank in all situations. If you already have 10%, 15, we have clients saving 50, 60% of their income that are, high income earners. You would never want to keep that in a bank. There's no point. And, so we have capital creation, then capital capture. This is where we're going to store the money. From the capital capture is where we're going to deploy it into cash flow creation and then capital growth creation assets. That's going to then cycle back into our capital capture, and it's just going to keep, the cycle going. From there, that's just, like an individual level. From the bigger scheme, now we have trusts involved, and we have, family generation planning involved, where that capital capture account is going to include a death benefit. That death benefit is going to go to the trust. Trust is going to fund the premiums of the next generation, so on and so forth. It's one big cycle. But I guess, to answer the original question, there's no one size fits all, and it will work for everybody. It's just a matter of how fast it'll work. Everybody needs a car. Everyone needs transportation. Everybody, spends money. So it's just a matter of flowing that money through a system first that's going to accumulate uninterrupted compound interest and then spend it. And then that way you never lose the opportunity cost on those dollars.
Yeah, absolutely. So I guess, even though it doesn't, it kind of fits everyone. I guess, do you have like a suggestion for where people should kind of be with this? Because like I would argue that, it could work for somebody, but if you're like, I don't know, a single income earner making $60,000 a year, I don't know if you should necessarily be going and putting all of your liquid cash into something like this, because I know it does reduce the cash value over the short term, so you can't access all of it. But I mean, or maybe I could be wrong. Maybe I'm looking at it the wrong way.
Yeah, I mean, I would say that person, they still have to save money, no matter what their income is. Everyone has to save. So it's just a matter of where do they save it? Is it in a qualified retirement account? Is it in a savings account? Or is it in, a whole life account? There's pros and cons to each. And like I said, it's not going to, one size fits all is not going to work. I would probably steer away from some of them, but I'm also, I'm passionate about this. So.
Yeah. Right.
Yep.
So awesome.
Yeah.
So before we kind of get into the last bit here, I would love to hear just a little bit more about how you use this for your investing as well. Because you talked about at the beginning, we never went back to it. I apologize about how you started buying houses yourself, and this was a product that you used. So like, what was that situation like for you? So people have some tangible examples.
Yeah. So I was buying single families, duplex, triplex. I had one quadplex, just locally here in Philly, and then in parts of Pittsburgh too. And, I got to a point where all my cash was deployed, and, I couldn't convince my private lenders to do 100% financing. So I kind of had like a period where I was stalling until this flip sold, until this one was refinanced, anything. Then what I was doing, in the meantime, was learning IBC through the owner of my firm. And when I had those flip sales, I did same thing, a front loaded policy, paid a front load up front. And then I was able to just use those funds to cover my cash to close on properties going forward. I've used it to buy cars. I've used it. I actually bought an airplane with my cash value, which was pretty cool.
Nice.
Not like a jet or anything. I'm not that.
Not a G6.
No, not yet.
That compound interest is crazy.
Yeah,
man. Yeah, 30%.
My partner at the time and I had a crazy idea where we wanted to go get our pilot's licenses, and we, I don't know how much time we have real quick. So
yeah,
we went to the local pilot school here in Philly, and just to get info. And it was like $14,000 between plane rental and plane lessons to get your pilot's license. So we like jokingly said to the manager there, we were like, well, what if we like owned a plane? Could we just take lessons in our own plane? And he's like, yeah, absolutely. People do that all the time. So we were joking with him, and we were like, all right, we're going to go buy a plane. This was a complete joke at the time. We were like, we're going to go buy a plane, and then we'll come back, and then we only have to pay for instruction. We don't have to pay for any plane rental, which plane rental is like anywhere between $150 and $200 an hour, depending on the plane. But so then he says, if you find a plane that's instrument rated, I'll lease it from you for the students, because he needed another plane in his fleet that had, a full instrument cluster. So we were like, okay, well, we'll find one. So my partner finds this plane down in Texas that, it checked all the boxes. The hours were good. It had all its paperwork. It was instrument rated and everything. We sent him the link, and we just said, hey, if we buy this, would you lease this off of us? He said, yes. He actually sent, the manager was so serious about it, he sent somebody down to Texas to do an inspection on it. So we did like a pre-purchase inspection, made the agreement. Buying a plane is actually very easy if you to finance a plane. I mean, because we didn't have to pay, buy it in cash. We were able to use, a combination of cash value from both of us, and then from, financing terms. And we were able to, he flew it back to Philly, and now I still own today. It's actually for sale now, but we were able to lease it to the flight school, to students taking lessons in it. And then we have a lease agreement with the school, for maintenance and insurance and everything like that. But I never followed through with it. I hate flying, but
but you own an airplane.
Oh man. If you've never been in a small plane, anybody can just, blow in their breath and you'll feel the turbulence. So,
yeah,
my partner, he finished out his lesson. So, he only had to pay for instruction. He was able to take all his lessons in our plane and, finish out his instrument rating and everything. And, he essentially, from the cash flow from that, he was out of pocket nothing. So,
man, you should get back into it, dude. Those little planes are durable, man.
Oh,
I went to Africa last September, and I took this little tiny plane on this like sort of scenic trip across Namibia. And dude, there's like duct tape on the wings of this thing. Like,
It did just fine. Yeah. Jesus. It is. So, that's a nice plane, man.
Yeah, that's super nice.
That's like a four. Is that 4-seater?
4-seater,
6-seater? Yeah, that's a good plane.
2 adults and maybe 2 small adults.
Man. Yeah. Let's fly an airplane, Mike. I don't want to learn to fly either, but it sounds like a great investment, actually.
So you basically were able to use your infinite banking money to go and buy this asset that you then buy this potential liability that you turned into an asset by leasing back.
Basically NetJets. He's basically a NetJets guy. He's just leasing jets.
It works. It's essentially like, I always compare it to like a double net lease, because so the flight school pays for the insurance and then maintenance is split. They pay for labor, we pay for parts. And so far, that's never been an issue. We've overhauled the engine and it's been, we've got cash flow every month coming in from it. So
that's cool.
There you go. Yeah. I mean, that's the same concept you can apply to like to real estate as well.
Yeah. Best part too is you can get bonus depreciation for 2 years on it. So
nice. There you go. That's perfect. That's awesome. Yeah. Well, very cool, Karl. So as we get into the last little bit here, we always have our finishing questions that we ask every guest. Cool. First one, and I know you have some real estate experience, but if you don't have a good one for this, you can give us a business story as well. But what is your craziest real estate investing story? It's gonna be a good story, bad story, anything in between.
Craziest. So actually, one of the reasons why I sold, most of my portfolio, not all of it yet. I'm in Philly with a lot of units, and it took me literally to the month 2 years to get a tenant out. And this was like during COVID, during the moratorium, and trying to do it the legal way. So there's, obviously ways you can get people out, but I was too much of a baby to do that. So we bought this property. It was a partner and I, and it was like February of 2020. Yeah, because we got her evicted this year. She did not. It was a duplex. Both units were occupied. Neither unit were paying rent. We knew that going into it. We didn't think it would be as crazy as it was to get her out. This was like the kind of like start of COVID. So, we didn't have the moratorium at that point. We thought like 90 days, maybe 6 months at the max to get this person out. So we buy this property. It was a great, price, decent area for what we were looking for. And turns out we can't get her out. We're going on, literally, it was like we filed for an eviction basically immediately and did not get it approved and have the sheriffs come out until February of 2022. This entire time, for 2 years, the tenants, nobody paid us anything. The day the sheriffs come out, which Philly is absolutely, completely not landlord friendly at all. They made the day the sheriffs came out, they made me as the landlord pay for a moving company to come move both at the time it was supposed to be just one person's stuff out and a storage unit for 30 days. And the sheriff said they were not coming out unless there was a moving company on site that day. So we did, during this 2 years, we did get the second floor tenant out. She moved out willingly just because she found somewhere else to go. So we were under the impression for the majority of the year that the second floor was vacant, first floor was occupied. She wouldn't let us in. I was out there so many times with the cops trying to get into this house, and there was nothing we could do, short of hiring people to remove her. But anyway, the day we did the eviction, the sheriffs are, they're like, yeah, this is for the whole building, right? And we're like, yeah, I think the first floor is occupied, second floor is vacant. And they come out and they're like, there's people on the second floor. And I said there was, but I thought they moved out. And they said, no, both units are occupied. Well, now they're getting removed by the sheriffs, and the second floor family, it was different than the people I had saw before that were moved in. The second floor family was super nice, and they had no idea what was going on. And they said to me, they were like, yeah, we've been paying her rent for like over a year. She said this was her grandmother's house and she inherited it. So this lady on the first floor, not only was she not paying us, but she was collecting rent from the second floor tenant for like over a year. And then like I felt so bad for that family too. And I was like, look, I didn't know this, I'll help you find another place to live. And, we were able to get them something else, but then get both units vacant. So that was pretty crazy.
Dirtbags. Yeah. That's the one thing when you find like true dirtbags, they're hustlers, man.
Oh yeah.
Like they know how to scrape by. In Philly or the city.
Yeah. Oh yeah, right, yeah. Right. What I'm more curious about is you can hire people to evict your tenants for you in Philly.
We'll talk about
that. Was it like a Craigslist ad?
I think that's like the similar as how you hire the mafia to protect your restaurant in the corner.
I've never done it because I'm a baby, but there are people you can. Yeah.
You can hire? No shit.
Well, there's actually, it's funny too, and this was not me. This was somebody else I know, so I can tell the story. But they had a squatter situation too. They paid somebody to squat on the squatters until the first squatters got out. So some guy just comes in and moves all of his stuff into this house that already had a squatter in.
That's actually hilarious. Right? That's really funny.
Like, first world problems require first world solutions right there. Right. Like that's
You squat, I'm going to squat.
Yeah, exactly. But we've said that. We've kind of joked like that too. It's like, man, we got to get too low. We should just move into that unit.
Seriously,
like just along with them. Just go in there and
you come in with a moving truck, start moving furniture.
Oh man.
I'm your new roommate.
Yeah, that's crazy. I'm glad you got out of that. I had a similar situation with a tenant. I inherited them with the property. They were due for their lease to expire. They paid rent when I first bought it, but they were just terrible people. And then the lease was due to expire April of 2020. And then we all know what happened in March. COVID started. Everything shut down. I finally got them out in September of this past year. This year.
Yeah, same here. Philly is crazy. I couldn't imagine like the week before the sheriffs were coming out, I got a phone call from the sheriff's department and they said, do you have a moving truck, ready and a storage unit? I said, no, what are you talking about? They said, you have to pay for the moving company and the storage unit or else we're not doing it. So that was another, $1,500 on top of everything else.
Yeah.
That's wild. I can't. Yeah, that's not cool.
So. Yeah. My person, I think that they ended up costing me about $12,000. Just in general costs of like missed rent and like other sort of BS, not paid utilities, all sort of stuff.
Oh yeah.
And then I had to redo their entire unit because they were just freaking savages in there.
Yeah. I mean, if I calculated what we lost in rent, it would probably be over that. Yeah. Like somewhere up there.
Yeah. So anyway, people, man, it's crazy business. That's why you have reserves, though. That's why you set up infinite banking so that you can be making money on that $30,000 you're eventually going to need to figure out their situation. So awesome. All right, next question. What is one piece of advice you would have for a new real estate investor looking to get started or a semi-established investor looking to take their business to the next level?
I'd say, I'm always big on just always being curious and always continuing to learn. I think some people and to newer investors, at least what I've seen, because I do a little bit of coaching too with newer investors, and a lot of people, and I don't mean this in a bad way, it's just kind of like human nature and like the American way, I guess. When you graduate high school or college, you just stop learning. You're not fulfilling or not, you're not, continuing your education outside of the traditional school system. And I would always tell people that come to me and like, obviously I left the police department fairly young and I'd have cops that come to me like, yo, I really want to get into real estate. What should I do? I'm like, dude, go read 10 books on real estate and you'll be fine. Yeah. Like, that's all you need. Go, there's an online course somewhere for $500 on real estate. And it's, people just stop learning and, you can learn. I've learned so much more since I graduated college than 12 years before that, just from, mentorships, masterminds, books, online courses, just networking and mentoring with the right people. So I'd say just, always stay curious and continue learning.
Yeah,
that's great advice.
And to add on to that too, learning is a skill, which I think a lot of people don't realize. And that's one of the reasons it's hard for like the, mid 30 to 40 something that's wanting to make a life change to be able to do it is they haven't been learning for the last, 15 years. Yeah. Now they have to relearn how to learn, which is not an easy thing to do.
It's a perishable skill.
Yeah. When like I've talked to people too, and I'm like, I'll give you like your first real estate book and they'll be like, dude, I haven't read a book in 10 years. I'm like, that's why, that could be why you are where you are.
Yeah, exactly.
Maybe.
and as that skill gets better too, it's amazing how much easier it is to remember stuff or to apply things. Even now, I have my wife, she'll be like, how do you know just like these like random things about stuff? Like, I don't know. I like read a headline and it stuck with me. Yeah. And I guess like my learning muscles are strong enough that just sort of like,
they're just ready to go all times.
I said to somebody last week, cause I sent him a book recommendation. He was like, I'll get the Audible because I read slow. And I'm like, you're never going to increase your reading speed unless you start.
Unless you read.
Yeah. So it was, Audible is good. Don't get me wrong. It has its place, whether you're driving or you can't read a book, but to actually learn and to get better, if you're a slow reader, the only way to get better is to read.
Mm-hmm. Yeah, that's true. So yeah, great advice. So awesome. So last question, where can people find you and reach out to you if you'd like them to do so?
Sure. So, if anyone's interested in infinite banking, our website is producerswealth.com. We have a new podcast, The Producers Bank. The owner of my firm has a podcast, Cashflow Ninja. Any of that, everything's on the website, where you can reach out about IBC. If you just wanted to, connect and say hi, my Instagram is Schnitz93. I'll send it to you guys so you can have it. And I'll send you my email too. You can throw in there.
Cool.
Perfect.
Instagram and Facebook's just my name. Facebook and Instagram, I'm fairly big on until I hit my limit for the day. You got to set limits on them.
Yeah, right. Yeah, there you go. Cool. Well, thanks so much, Karl. You're a mountain of wealth in this stuff, and a topic that, it's an interesting thing to sort of wrap your head around. But once you do, and you kind of understand the value, like you said, of the compound returns, and
that's the thing too. And you gotta research it with an open mind. It took me, honestly, and I hate to even say this, it took me like 2 years from the time I first heard about it until I started my first policy, because I heard about it, thought it was like a scam, thought it was, nothing serious. And then the more I networked and, knew wealthy people, they all, stored their money in insurance. So then that's when I kind of gave it, more look. And, something else we can do too, which I've done on other podcasts. If you, I get books pretty cheap through the Nelson Nash Institute. So, I have a stack of books of Becoming Your Own Banker, which is the, book on banking. So what I've done before, if you guys are open to it, anyone, first 3 people that can, share the podcast and rate it for you guys, I'll mail them a free book.
Hell yeah. You heard it here.
Awesome.
That's awesome.
Yeah. I appreciate that. Yeah. So you guys heard that. Go ahead and
mattresses.
Yeah. Yeah, there we go. So you guys heard that here. If you go and you share the podcast, I've listened to this episode, and send it to either Dan or me or Karl on Instagram, then we'll send you a free book. So that'd be pretty sweet. Cool. Awesome. Nice. Well, thanks so much, Karl. Appreciate you coming on. Yeah, absolutely. And thanks so much for listening, everybody. And we'll talk to you guys next week.
Yeah. Thanks, Karl.
Yep. Thank you.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.